myself.
All right, can you guys hear me? How's this? How's that? Is the audio
Okay.
clear?
Yeah, they can hear you. Okay,
Sweet.
cool. So, I'm gonna ask you to share your screen, and then we'll have your screen up on the stream, so they'll be able to see whatever you're sharing.
Sweet, I'll do that now.
So let me see here. Uh, Perfect. Okay, so I'm gonna bring this up. I'm gonna pop it out. I'm gonna go live scene. All right. So everyone, you should be seeing Roman's screen now. Let me know if you can see it.
Sweet, is that working?
I think so. I mean, I can see it, which means they should see it. Okay. Thumbs up. So let's just start with this, bro. Let's do a quick maybe intro. Who are you? How'd you get into trading? And we can kind of start from there.
All right, sweet. My name is Roman. I've been trading full time for about 4 years. I got into crypto mid 2017 during the dump in July. Had no idea what I was doing, but I've got the ability to pick up patterns pretty quick and learn very quickly. Um, So I started to notice before I even knew technical analysis was even a thing that you were able to start longing or shorting or buying spot or whatever your approach was back then, based on a few certain things I picked up that played out over and over again, which then led me down the rabbit hole of learning about candles, trend lines, trading view, um, and it's just been a huge snowball since then. I absolutely love data, I love statistics, which go hand in hand with trading, I think. Um, So, what would you like me to cover? Let's get into it.
Yeah, so you've been highly requested. I've had tons and tons of people come on my streams saying, that they've been sent by you, so I appreciate that. And a lot of people wanted me to do a joint stream with you. So it's interesting to hear that, you kind of started off trading from like a pattern recognition standpoint, right? So you're into data, you're good with pattern rec, and then obviously you've taught yourself some what I would call price action,
Yep,
and kind of, realized, and I think what a lot of people realize is there is rhyme to the reason, right? Patterns repeat in the markets, and things can actually, be predicted to an extent using things like, candlestick patterns, trend lines, supply and demands, things like that. And I love how simple your type of analysis and the type of analysis I do is. And that's what drew me to it the most. Like when I first got into trading, I actually really got into indicators and stuff.
yep,
And I found that all of these indicators were just kind of displaying price and volume in a different way. And once I realized all you really need are the candlesticks to really get kind of the meat and potatoes of what's going on in the market, I was able to clean up my charts a lot better, get a lot less noise, and get something that worked for me. I definitely like to tell people there's no right or wrong way to do it. If what you're doing works and you're making money, do it, right? Just because I do it differently than you, it doesn't mean I'm right and you're wrong. But personally, price action is what kind of spoke to me and what made the most sense to me. And it's cool to see, someone who learned a different way, but kind of ends up with similar results. I love always talking to them because I think there's a lot of ways to, skin the cat in trading. And I love to talk to other traders and just see what they do and what works for them. And I think it's a lot of value for people as well. Okay, they're saying you're a little loud here. I'm gonna turn the volume down here a little on my
sweet
end.
as.
Yeah, it's on my end. I had it maxed. So why don't you give us and guys, Roman's Twitter handles in the description of the video, so check it out there. But why don't you give us kind of your view on Bitcoin right now? Did you get bearish near the top? Why? And what are you looking for now in terms of areas of potential reversal or potential further downside?
Sweet, sweet. All right, I'll get into it. What I might do, I've got some stuff prepared for your viewers. I like to actually give a bit of a show on, so I might just get into some stuff first, and then we'll go into Bitcoin as well. This is what I look at. I try to break everything down into a horizontal trading ranges, and then I then approach every other aspect of trading styles like patterns or naked price action itself, SFPs, divergence from RSI, Ichimoku. I look at the market from everyone's perspective and then make up my own from that. And it seems to give me a huge accuracy within the market when you can understand everyone's perspective, but you've still got your own trading style. So naked price action is the king, and I always come back to that. But I use these other things as like a point system, um, and then add from that. So like when we were back down here, I was looking to get long, while a lot of people were freaking out because it was just for me, it was just trading range, right? This is support. I think you might refer to that as an order block. I'm not sure, and then which has then been a demand zone since then. So I usually trade the market as horizontal ranges, and that's my go-to. Um, and then I'll just bring up a naked chart. I'll show you how I played this morning. That might give you an idea, and your viewers an idea of how I approach the market. So the pattern recognition that I picked up has helped me tenfold. So I'll get into that. Where is the first one? Here. So this is a pattern that I noticed that plays out quite often. It's called the Broadening Descending Wedge. Very basic. It's just a few waves, a particular wave, usually an SFP down here somewhere, usually divergence between this low here, which then plays out. So while I was watching Bitcoin puke this morning, I was getting ready to long because it started to tickle my boxes, and so we're coming down to the previous low of the range like you covered earlier for the SFP here, right? We took that low out, the 5 minute closed back above. For me, there was an instant long, as well because of additional low we took out, which is the wick way back here as well. Right, we took out that by a bee's dick. We come back. Right, we just wicked under that. So all stop losses got hunted in that 5 minute wick, and was game on from that point onwards. We already had daily divergence building from RSI. The 4 hour had already diverged as well. It was just a nice clean setup. So from here, I'd be looking exactly like you, I think. For me, this is a supply zone. This is the most likely place people will sell, so therefore it's supply, right? We reclaimed the lows as we pumped up through that, so I'd be expecting a retest of this before continuation. That's usually how they play out, how most trading ranges play out. Because to me, all these are is trading ranges. We've got the one here. I usually use the channel tool. It's probably my favorite tool within TradingView. I always use candle bodies. I notice you use wicks. I usually use the candle bodies. I'm on log, get rid of log scale. Right. So this is my range. This is the deviation away from it. If you understand Wyckoff theory, this is a low time frame distribution before we get pushed down. And then this is potentially reaccumulation off the mid-range of the trading range here. So we had the SFP come in on the 1 hour, the 5 minute, 30 minute. I'm assuming now the 4 hour as well because of the time since then. So it was an easy long from down here off the middle of the range. But then because I trade ranges, I break everything up into ranges. So this here is also a range from that swing high to swing low, candle bodies, right? And then I'd also treat what the current price action between here and here as a range as well. So if you get to one side of it, I then assume we're going to the other, especially if you get some kind of like rejection of it here after an SFP. For me, this is an SFP here. I don't know if you'd call it one. Where we've come up, we've actually swung the high of the previous candle's wick here. We've swung the high, we've then closed back under, and then we puke. So I'd short that, or hedge there, expecting exactly what played out. So I think your logic wouldn't have called that an SFP, right?
Well, if you go to the hourly,
Yep.
it'll be an SFP, right?
I gotcha.
So
Yep. Yep. Yep.
it's for most people, they'll look at it, okay, the three candle kind of swing is the easiest way to describe it. But if I see a high time frame, like a weekly candle wick above the previous week and close below, I know on one of the lower time frames that was a legit SFP.
Yep.
But that's a little bit more of a advanced concept. I don't try and confuse people. I say like at least initially you want to see that kind of swing low get run. But as you stare at charts more, it's no different than like I can look at the 4 hour chart and be like, okay, this is like a daily supply zone here based on the 4 hour chart, right? So
Yep.
an SFP, the strict way is kind of what I explained to you guys earlier. But anytime we run above a high and then close right back below it, even if it's not like a perfect wick, it's really think of it as a deviation. That's all an SFP is, right? We ran
Yep.
above a high, closed right back below instantly. To me, that's a sign of weakness.
Yeah, I agree completely. So the way I approach it, like this one here on a lower time frame will be the SFP. So on the time frame I'm on, if I'm watching the 1 hour, for instance, if I go back to that SFP here, you'll see it come in and then reclaim the dominant level, and then it's pretty much game on from that point onwards here on the higher time frame. Usually what I look for when we come into these SFPs is 3 particular dips, and on the third dip we usually breach trend if you're using slope trend lines. I think they're a bit of a meme and they shouldn't be traded off, but they are good to approach the market from this perspective, where if you understand the market structure that's forming, it's usually that third wave down here is where the SFP happens. And while the SFP happens, you'll notice on say the RSI, not that one, where are we here? On say RSI, the bull dip will form in this last low like that. So you get a few different confluent factors all at once, and that's when I'll take the trade. I get very confident once we've reclaimed that horizontal level after the SFP. So on this 5-minute time frame we're on at the moment, we can see this one little candle swung the low of that previous wick, claimed higher. I'd be then interested in looking for that time frame or higher, looking for the reclaim of this level to lock in the higher time frame SFP there, or the way I refer to it as an SFP, which then gives you that nice clean bottom entry here, right? So those 3 dips I'm looking for in particular, and then the SFP on the third one. So 1, 2, 3. We just had the same thing again this morning here on the low time frame. For me, I love maximizing my risk to reward, so I've fine-tuned my ability to pick bottoms without ending up with smelly fingers, right? So on that third dip here, we breach trend and we SFP. There's bullish divergence here on the low time frame. Take that trade, and then your risk to reward is amazing from that point onwards. Sniping bottoms is risky as hell, though.
Are
Hey?
you putting your stop at the low of the SFP? Is
Yes.
that how you define your risk?
Yep. So I'll long the open of this candle. I will not front run the SFP because we know very well in the last few seconds that could just puke. So once this candle was locked in, then I'll be opening the long on this one. The stop loss below here. Your risk to reward then is amazing from that point, but at the same time, you've really got to understand the macro structure, like you talk about, all the time frames coming in together to understand like this was an SFP here, for instance, of this level. We swung the low, then go back above. It was only a weak rally though, so if we break that down on say the 30-minute and go and have a look at that, we'll clear that off. So even though this was the way I look at the market would be this would be an SFP with a bit of a pin bar here. It was no real level here, right? And there's no real volume in this either. So we'll bring up the volume. I'm definitely a volume trader. I appreciate volume, can give you a bit of an insight. But we had a very, very small deviation of volume here. Right, slight increase. It's still nothing compared to the previous low. We didn't really swing any important lows from the left. I always look left. So we didn't actually do anything. It was just this is just chop really. So when that one came in, I didn't get too excited, and I was waiting for the swing of the main lows down here. And then as soon as you get that swing, especially with that looking far left to this low, that candle here, right? When we swung that low, I'm like, it's game on once we reclaim that, and then got long again. I think I'll touch on order blocks real quick because you've got your own approach to them, and I might just touch on how I approach them. It's a little bit different to yourself. So the way I picked up it, because I've observed many different people's trading styles, I picked up good things and bad things from people. Audited the bad, removed them, and the rest of it. So the way I understand order blocks is also combining that with order flow, but not in the order flow that the low time frame traders talk about. I understand it as in this is order flow, price is flowing, right? And then we get to a point where there's a block. It's usually after a sequence of candles in a row, and then from that point onwards, price is blocked until you usually get a retest of it while it's above the order block itself, and then you push on, right? So for me, I'd call that an order block here, because we had a sequence of candles running into it. Price got blocked here for a period, and then once it closed after the retest, we then pushed back up. So order flow was happening again, right? So when we come back to it, it blocks price. When we come back to it again, it blocks price, and then the third time again, it's still working as that key level. So I look at for me for order blocks, it's more during trend after a series of candles, where I think your order blocks were usually at the end or the top of trend, based on a specific logic of maybe the reversal candle. I'm not too sure. A lot of my followers have talked about yours a lot, and we're actually programming yours into an indicator that I might have to give you access to automate them for you, because it makes life a bit easier when you don't have to draw in all your order blocks. I'll just show you an example, right? This is indicators that I've made with a friend of mine, and this draws in my key levels instantly. And I go to different time frames, it draws in my key levels that I'm interested in. So it'll just load any second now, hopefully. Right. So when we get to these key levels and I pay attention, these are not order blocks or demand or supply zones. You could call it demand and supply and the logic that people were more inclined to buy or sell there. Um, but I'd call this demand here because that's where, if and when price comes back to that, there'll be a bit of demand for it. It's just purely based on that logic where at the start of your stream, you're talking about ICT, how you were taught order blocks for the lows or the highs or the swing point. For me, that's where demand and supply is. Um, and I'm self-taught though, so I've had no formal training. I've got no ICT training. Those guys they are great. Very logical approach to the market. I can truly appreciate logic because you can just repeat it over and over, right? Um, so my logic is that the highs and the lows are demand and supply. So when we retest previous highs like this one here, right, it becomes a supply zone for a period. There's additional supply happening right here, right, and then when we come back to it, it becomes support. We push back on. Like you mentioned before, the free drives pattern that played out. This played out perfect. If you actually fib the free drive pattern, it came back to the 618 here perfect as well, which is an easy long after that SFP. And then once that rising wedge formed, and then Elon Musk tweeted, it was a pretty much no-brainer. The path of least resistance was going to be down. Hedged the portfolio there and then just rode this down. Called the bottom here in this candle. I said we're not going to go lower than that price here. Actually made some bets or some bears, actual cash bets back then. They still haven't paid, so waiting to get paid out from the bears that are underwater still probably. Um,
Can't pay bets back if you're broke.
That's it. That's it. So as you were saying at the start of your stream, risk management is key, right? If you've got no capital, you can't play. Um, Touching on that, I want to touch on that and show your viewers the way I approach risk management and the market, right? So this is a running balance forecasting cheat sheet. It's a really good way to get people's head around how trading actually works and how traders stay profitable even when they lose, right? So on the left, you can see the strike rate, 60%. So that's been fair. You only have to win more often than lose. You don't have to be amazing. 60% is very easy to achieve, in my opinion. The risk to reward rate, 1 to 4. If you chase in at least 1 to 4, that means you're covering your losses no matter what, right? As long as you win 1 in the 4, you're going to cover your losses and break even. You can change that to 3, and then we'll update the running balance forecast here, and you'll actually still see that you're still profitable, even if you've got a lower risk to reward rate there. I'd try and chase 4 or above. My training strategies that I take are much higher in percentage than this, so the running balance climbs faster. This running balance isn't compounding your new balance every time you lock in the trade either. This is just off that $100,000 every time, and you're risking $1,000, which is 1% of your total account every time. So risk management shows you here, if you risk 1% total equity, and then you use your stop loss to define how much of that goes in, then as long as you follow your risk management technique or your whatever it is that you have, you're going to end up making money. You're going to have these down moments where you lose a bit, but ultimately you're going to be right. But then because we're not robots and we can't all just execute like this, I've got a spastic period feature that I've added into this from my coder. When we change this to Y, what it does is throws an extra 10 losses in a row. We can see them here just kick in. For every 100 trades, it throws an extra 10 losses in, and it shows you, even with those losses, so if you have a really bad period, say you're going through some kind of breakup or you default on your mortgage or something stressing you out, and you just for some reason you're just losing a lot. I had a losing streak myself after COVID. That dump removed a lot of the liquidity in the market, which made things a little bit harder. I trade in large sizes, so I had a down period during the COVID. But anyway, this what it does is shows you an extra 10 losses than usual, right? So this is making it even worse odds. But as long as you practice your risk management every time and you chase your 60% win rate strategy every time, you're going to end up ahead. Even if you have these drawdowns and you're like, what the fuck, I'm bad at this market. As long as you stick to the guns, over time, over 1,000 trades, you're going to end up with a lot of money, right? So that's not compounding.
Yeah, so maybe I'll just comment on this because I think
Yep.
this is a great spreadsheet. I have something similar on Excel that I built. I don't think people understand this shit well enough, and it is so so important. And I've pulled up the chart a few times. If you're aiming for even a 2 to 1 risk reward, guys, you only have to be right 33% of the time out of 100 trades, right? 33 trades, you got to get right to break even. That's not very good trading, right? That means like one out of every 3 trades is the one you're getting right. You're losing a lot more than you're winning. You're still going to be able to break even if you have that 33% strike rate and a 2 to 1 risk reward. And that the whole point of asymmetric risk reward is to allow for these periods of losses. That's why it's so important, right? It doesn't matter how big your position size is. It doesn't matter what your leverage is. All that matters is that you have a system that allows for losses. And when you lose, you know how much you're going to lose. And when you win, you make more than you lose. That is the key. And the higher your strike rate that you aim for is, obviously, the more losses you're going to be able to allow for that get made up, by those wins, because the wins in, Roman's instance here are 4 times the amount of loss. So this is super, super critical to understand. This is how you can experience periods of drawdown in your trading, but still come out ahead. This is going to help you keep your money growing over a long period of time. But what I think a lot of people, a quick mention on the compounding, what he means by that is it's a static risk. It's 1% of the initial balance. He's not say so if you win a trade, now your balance is 100,000, 104,000. It's not 1% of that. It's 1% of the initial 100,000 every time. So if you actually were to compound, which a lot of people do, and that's a really good way to grow your account, is when you're compounding. Okay, well, now my account's 104,000. My next trade is going to be a risk of 1,400 or whatever it is, and it will grow as your account grows. But this is showing, just even with static risk, how you can grow an account over a period of time. But one thing that you have to pay attention to here, guys, is you have to have a strategy that gives you consistent results. And I talk about this all the time. People are always changing their strategy. They're doing price action, then they're looking at indicators, then they're doing this. Your data is irrelevant if the inputs into the data set are not the same every time, right? There has to be certain parts of your trading strategy that are static. If you're changing what you're doing and then all of a sudden you go on a big loss streak, well, maybe that due to just, hey, I'm losing, or did I change what I was doing in the first 100 trades versus the second 100 trades? Your system has to be exactly that, systematic. And you do the same thing every time. I know that I'm not going to get every trade right. I know that already. And my system, because I use proper risk management, I aim for asymmetric risk reward, it allows for losses. And I don't get stressed out when I'm on a losing streak, because I know I'm going to get back on a winning streak at some point. And those wins are going to offset those losses quickly. So you have to have a system that, when he's talking about how much he loves data, your data is irrelevant if the inputs into the system are changing constantly. Right? First thing you got to do is figure out what is your system, what are your tick boxes to get into your trade, and you got to use those same things every time. Obviously, there's some discretion involved in trading, but the more objective you can be, the better.
So this is the chart I'm showing you now. This is actually taking in compounding. Even with the spastic period where you have your emotional run of 10 losses in a row, you still end up with stupid amounts as long as you stay consistent. As you were just talking about, consistency is more important than accuracy. All you have to do is be 60% right of the time with a wonderful win streak, and after 1,000 trades, you and your entire family are retired. So you only need 100k balance to achieve that. I'm not saying this is possible, everyone's going to be able to do this, but it, once you
Just
understand the
just
data, you
just
respect
for
it.
fun, change the balance to 5,000, because I know
Yep.
a lot of people here aren't trading with $100,000.
So let's go 5,000, and we'll just change the, we're using 1% equity, alright? So that means it'll be what? That'll be $5? No, $50?
$50
$500?
a trade.
Yeah,
$50 a trade.
yeah. So even with, this is compounding, and even with the bad period, so the 10 losses in a row, this is a lot of losses. Look, you can see them all here. The math is all there, it doesn't lie. And then you have your down periods over and over and over again. You see, even if you just stick to your consistency, you're going to make it. Alright? You've just got to really, like what you said, you need to have your go-to strategies that you've got the data on, right? So talking about that, while we're on that, I'll just show you something that I've done to help a lot of people out. I think this is where this has made a lot of people realize data is really important, and did a couple of simple price action studies with quite a few people, and what we did, we just cross-referenced basic market patterns with indicators and targets and the rest of it. Um, we've got over 1,500 responses on, say, this one, and this is just based off the ascending triangle. I'm sure you know what the ascending triangle is. You would have seen that once upon a time in your journey of
Yeah,
indicators and the rest of it. So
definitely.
pretty much all in the ascending triangle is when price comes up to a certain point, it rejects, it comes back up to supply, and then rejects again. The third or fourth time, usually you break through or making high lows into that, right? It's not always as clean as this. Bitcoin loves doing this in a bull market. If you're taking ascending triangle trades in a bull market, your accuracy, it's insane. The data proves that. So what we did was cross-reference that pattern with indicators and worked out like if you were to cross-reference an ascending triangle with, say, Ichimoku, how often was Ichimoku correct? So if you took the traditional rules of Ichimoku and cross-referenced it, actually 85.9, so 86% of the time, you're going to be right. So that could just be your trading strategy. You're a bull in a bull market who uses Ichimoku cross-referenced with an ascending triangle. So we go back to the sheet and we change this up here to, say, 85%. Um, Even with $5,000, you're Bill Gates after 1,000 trades. It's not as simple as that, but that is accounting for a spastic period too there. The thing is, you need to do 1,000 trades consistently using the same strategy over and over again. You need to execute like a robot. Remove the emotion, remove your thoughts. You just completely remove everything out of it, and then chase that 1 to 4. Right? It's not as easy to do. We are humans. We do make mistakes. We do forget stuff. We have bad days, bad periods. But that was accounting for like 10 losses in a row as well. So I have this kind of data on all the different kind of patterns, but it also tells you where to take profit as well. So if you into a price discovery or you're not sure where to take profit, it's like, cool, you've mastered your entry, but how do you take profit? Right, so it tells you where to take profit based on the likelihood of where they're going to hit as well. This data is from crypto, it's not from standard markets. The standard market data that's available out there, if you try and look into patterns, is actually pretty weak. So say a measured move target, right? 71.6% of the time it's going to actually hit your target 2. All right. So target 2, I'll show you what that looks like on a chart. We'll just find one that's empty. Here we go. So let's say, for instance, this is an ascending triangle. It's a bit ugly, but we're just going to do it for the stream nice and quick. All right. So we've got a horizontal top somewhat, got higher lows forming. This is your trade that you want to do. So target 1 would be, say, the impulse move within the triangle, right? So that's where you'd take profit on target 1 when we cross-reference, say, that over here. So target 1 hits 93% of the time when you add those two numbers together. Because if we hit target 2, that means we hit target 1 as well. So 90% of the time in a bull market, this will hit your target 1. That alone could be a trading strategy. You don't even have to chase target 2, you know. As long as you're consistently hitting that target 1, with your risk defined, you're going to make it. It's as simple as that.
Yeah, I feel like a common issue with a lot of traders is it's information overload, right? There's so many things going on. They're on Twitter, they're seeing, oh, this guy caught the bottom, this guy shorted the top, da 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 da.
Yep.
If you have, and that's why I always say in my streams, guys, I don't care about missing part of a move because I have a system that works for me. And as long as I'm doing the same thing over and over again and it's compounding over time, I'm making money. Maybe I'm not getting all the clout on Twitter for catching the absolute low, et cetera, et cetera. It doesn't actually fucking matter because just like Roman said here, you can build an entire strategy based on one type of setup. And as long as you're able to milk that in the market consistently over time, you can forget about all the noise in between. And your life becomes so much less stressful when you're not staring at the screen 24/7. You wait for your specific market conditions for that specific pattern to show up. And that's when you lock in. You don't have to worry about price when it's, trending super hard. You're waiting for that ascending triangle pattern to show up. Now's when you get involved. Now's when you start paying attention. It's unbelievable. I have so many friends who only trade one type of setup, and that's all they do. And if the conditions of the market are not giving them that setup, they're not taking any trades. They're chilling, they're waiting. And that's how it should be. You don't need to be chasing every single move. Get a system that works for you and then follow it religiously. And then obviously the math doesn't lie.
That's exactly it, man. Consistency over accuracy. Just keep doing what you've proven works. If you get bored and you feel like you need to trade, then find another proven strategy that you can have. Instead of just waiting for ascending triangles, okay, maybe you get bored or maybe you're impulsive and you need a different strategy. Well, then that's one trading strategy. That's what I want to cover as well, actually here. So a lot of people don't quite understand this, and I didn't understand this at the beginning of my journey too, because I had no one to teach me. But I think this needs to be nailed into everyone's head, and that is technical analysis is not a trading strategy. Okay, so a trading strategy is what we just covered, right? Where we've got data that proves after 1500 plus entries, remember, we've backtested this 1500 times, right? With this pattern, with these the entry here, you've got your stop loss defined, unless there's an SFP to use up here. Um, you've got your defined entry, you've got your defined exit where you take profit. Once you've got all of that, that's a trading strategy. But until then, your lines on your chart, these streams that Reeeowmayne does, week to week, the ones, that's mostly technical analysis. It's not call to action until that SFP happens, or whatever your trading strategy is that actually happens. So whatever's on your chart, whatever's on this chart that you're seeing here, is call to action based information. So let's say, for instance, we'll get rid of, we'll throw on Ichimoku. It's a common indicator that most people go down the rabbit hole of sooner or later in their trading careers. We'll go to the daily time frame. So if you're an Ichimoku trader, you might be looking to get long on the bottom down here. That's a call to action. But while it's in here doing a lot, there's not a lot going on. There's not much you can do. There's no point having it on your chart, in my opinion, if you're trading, because it's just going to throw you off. Like Main mentioned, if you're looking at Twitter and the rest of it, you're going to get a whole lot of information overload, and you're going to start making mistakes, right? So if you can have call to action based stuff on your chart, then you actually will start improving tenfold. You don't need to have every trend line on here. I watched a stream of yours last week or week before, I'm not sure, and it had Ninja on, and he had a bunch of different trend lines, and I'm like, it's unhealthy to be trading like that, in my opinion, because it's not real call to action stuff. It's not. You can't put that into data. You really, you're winging it, in my opinion. You need to define a strategy where you can repeat and replicate it over and over again. So that's why horizontal and price action is so king for me. I always use that as my floor and then build off that. If I have a random trend line like that, I'm not going to short it when price comes up to it just because price has reached it. Because you could completely miss out on the move that happens past that, right? So
What you realize over time is most people on Twitter, on YouTube, what they're sharing is exactly that. It's analysis, right? It's TA. There's a bunch of great analysts on Twitter, and I always tell people this, right? You can mark all the levels you want, you can have the order block, the trend lines or whatever, and then you can post the chart after the move happens and be like, boom, hit my level and it rallied. It's like, okay, but do you have a strategy that lets you get into a risk-defined setup at that level? Because if you don't, you have nothing. If you've
exactly.
marked the first step, absolutely, is get good at doing analysis. Find where the market is sensitive and get a skill set where you can mark up the charts and you can say, okay, when price gets to this level, I'm interested. But the next step is, okay, price is at my level. What the fuck do I do? And that's where your trading strategy comes from. How do I actually get involved in the market? It's just not buying the touch of a trend line. Okay, maybe that's your entry, but where's your risk? Why are you buying at this touch of the trend line versus the next one? You have to have an actual strategy that lets you get into the trade in a risk-defined way. And most people don't have that. They go on Twitter and they say, oh my God, Reeeowmayne posted that order block, it hit it and it bounced like he's a god. That means nothing if I didn't enter, right?
Exactly. It
It
needs
means
to be call to
nothing.
action. It needs to be if this then that. You need to get in the program. Sorry, the mind of a programmer. If price does this, variable 1, 2, and 3. What is my 4? What am I doing with that in data? If you've got no data, like if you've got no call to action that's back tested, then you're not trading. You're gambling, and you're not going to make it. Um, I think this is really important too. This chart here, it's called the what they call it, the Dunning-Kruger Effect, and I think everyone goes through this. Even professionals still go through this, which is why in trading floors, even the biggest of the traders out there, they usually have a team of psychologists that the traders will go and see, and that's because even though you're amazing and you know what you're doing, you are still human. So you go through these periods of your confidence will peak because your P&L is going up, right? You're seeing large percentage increases. You're seeing maybe $10,000 profit days or maybe $100,000 profit days. I know I've had my times of that. Your confidence gets up, your ego froths it, and then before you know it, you get rug pulled, and you're like, well, what happened? It's because as a human, we go through the cycle of constantly learning, getting wrecked, learning some more, getting more wrecked. But as long as we're managing that risk over and over, when we as long as we're managing risk and sticking to our data-defined strategies, we still make it, right? So I've seen a lot of people in the last 4 years get completely washed out when these dumps happen, right? Even these ones, they completely wash people out. They get liquidated, lose their entire account, lose everything,
Well,
and they,
everyone's a genius in a bull market, right?
but
Because
that's it.
it's, when you just got a long support, which basically worked for months and months and months and months, what happens when the market conditions change? And I've been around long enough to tell people, I'm like, listen, yeah, I think we're bullish. I want us to go higher. I want Bitcoin to make another all-time high. But at the end of the day, if a bear market comes and things start trending downwards, what are you going to do? And you don't have to trade a downtrend. If you don't know how or you don't want to, you don't have to. But then don't force trades against what the chart's telling you. You have to be prepared for the conditions to change. And if they're not favorable towards your strategy, then you sit and wait. But patience is a really hard thing that people have. I think one of the biggest issues people have, especially when they're new, is they get good at TA. They say, okay, this is why I'm entering. This is what I'm going to do when we get to my level. But then they have the issue of the time in between those things happening, right? So, okay, here's my key level. Well, now you got to wait for price to get there. And it might not get there for a while. Do you have the patience and the ability to sit there and sit on your hands and not do anything until all of those boxes are, lining up in your system? I always talk about a tick box, right? I have multiple boxes that need to be ticked before I'm willing to enter a trade. And if it does not tick all my boxes, I don't take the trade. And it might even work out. It didn't tick all my boxes, but what I thought happened was going to happen happens. And I missed the trade. I'm okay with that. When you're new, it's harder to, you get that FOMO, you get that greed, you feel like you're missing the move. Oh, it's never going to come back to my entry. I'm fucked. It's going to rally away without me. And those are emotions that you have to learn to first identify, and then you learn to how to control them. I always say the same thing. I was like, you want to be robotic as possible when it comes to your trading. And that's why you don't want to trade when you're on tilt and when you're emotional, like you said, just got out of a breakup, you're on a big losing streak, whatever it is. If you're tilted and you're reacting and analyzing emotionally, you're chasing, you're going to start doing things that are not objective. They become subjective. You want to be like a robot.
Yeah, I completely agree with you. I've got a big passion for psychology and philosophy, so I've been able to implement that into trading as well. And I've noticed a lot of people are either impulsive or very decisive. Um, you yourself come across to me as someone who might be impulsive, but you're mature and disciplined. So you've got these strategies. But someone who was, let's say, decisive, they'll stream every week, the same time, every time. Their bed will be the first thing they make when they get up every time. They'll have these systems in life outside of training that'll play out. It's kind of like a personality-based thing. Um, so someone decisive, they should really look for a specific trading strategy like Ichimoku or maybe MA crosses or specific things that they can outline that are not hard to do and they can just act like a robot and execute every time it says to. With someone who's like myself, and I'd like to say you as well, um, is much more point-based or tick-based system. Like, do I have my SFP? Do I have my bullish divergence? Do I have the level reclaim on the rally back up? If those three things happen, I'm going to long. So that's a point-based system. But if you had, say, an Ichimoku cloud down here, it's a support, and then you also had like a key order block over here as well, then you can add more and more of those ticks. And then if you can get a lot of these ticks, then you can also probably increase that risk appetite too, or add to it as it starts ticking these things off. So you got three. Okay, I'm going to take a position. The fourth thing happens, I'll take more of a position. I'll add to the position. Depends on how your trading approach. But I think as long as people audit themselves and realize what kind of person they are, they can then play their strengths. For me, I'm an impulsive person. I'm disciplined in my approach to that. But I want to be able to trade more often than not. When I was trading, day trading anyway, and that allowed me to have maybe 10 different strategies that I can somewhat mix and match a little bit because I knew the data of each of them, um, which kept me trading more often than not. Um, so yeah, those kind of, yeah,
Yeah, I think that's a fair assessment. I'm definitely an impulsive person. When I first started trading and then I kind of started building my first initial strategy, I was very, very goal oriented about it. as I got better, as I had more money where I didn't need to chase as much. Hold on one sec. I'm so sorry. Keep
You're right.
talking there.
I'll keep talking. All right, I'll show you guys why he's on the phone or whatever that was. Just my approach to the market that's quite different to others. So Doge went crazy in the last 12 months, right? A lot of people made a lot of money in Doge. This was posted in 2020, all right, just after the crash in Bitcoin. It was just posted on the halving of Bitcoin. So this is well before Doge has even moved, and it's actually started to bleed out. Something I wanted to show you guys is just how markets are cyclic, and once you understand the cycles of them, you can start profiting. So we noticed back here on the BTC halving, and back in 16, that it just bled out to the 17 sat level, or the 15 sat level that everyone talks about. I think it's 17 on Binance, and then took off, right? After the halving, bled out, took off, and then came back to that level again. So all data aside, you can see that these particular levels and cycles all play out to these little mini pumps, big pumps, and the rest of it. We can see here that that level is for buying. That's a demand zone for me. That's where I'd buy. So when price came down to my demand zone after the BTC halving, because we've got data here that shows it, that's what played out last time. Let's assume it's going to play out this time, and let's not buy until it reaches our level. But because we also understand the cyclic nature of it, we're able to predict where the next major pump will be. Right, so you buy and then hold. We can actually see this play out by pressing play, and we can see it came perfectly down to our level. This is published, so you can't edit it, by the way. It's a great thing about TradingView, it gets rid of the LARPers, right? So it came to this level here, and perfectly launched off it straight into the next major pump, and you were able to ride generational retirement gains, right? You could put 50 bucks on that, and you could have retired if you'd played this chart. Um, Another one, this is where my charts used to look like when they were messy and the rest of it. I'm still finding my edges, but the market cycle, right? It played out. Everyone brought the top. I was actually able and fortunate enough to sell up here, pretty much to the hour because I was tracking CME at the time, and I knew that the big money coming to the market is not going to long or continue to long an extremely parabolic market, right? So I was able to sell here. I told everyone in my socials to sell, and then we just we waited, traded somewhat of this, and then waited for the bottom. And then this was a bottom depression come in, and we can see that this plays out straight afterwards. Is you want to be paying attention when you start getting through this depression, which is also usually about an 80% retrace from your high. So if you use your fibs at all, not a bad level to pay attention to your 80% or 85% around there of retracements. These market cycles that play out like this was over a few years, all up. They play out on every single time frame, from the 5 second all the way up to like the 5 day or whatever you want to look at. All right. So something I'm going to show you is another one here. This is fibs, the power of fibs, and the power of measured moves. This was posted back in 2020 as well, right? It comes straight to our target here, and I've been expecting consolidation here. I wasn't expecting us to get through this, but I do think we're going much higher, right? I genuinely believe this market cycle is not over from a cyclic point of view, not from a technical analysis point of view. You need to always make sure you understand the context of what you think. So if we go and look at the chart here, we can clearly see that we're in a ascending market, making a high, a higher low, a higher high, a higher low. We've made a new high past the previous high. These things here would say buy the dip, right? So we look for reasons to buy the dip. We don't just buy the dip. We want to be able to find divergence, or find the SFP, find support, the order block. Make sure all the time frames are saying the same thing, and not just getting too carried away because we saw a 5 minute SFP run 8% or whatever the hell played out this morning, 9%. Right? Easy trades, these ones, and you're great. You make a bit of money doing these. But at the same time, a 5 minute rally like that on a 4 hour, it's just a single candle that's now looking like it could roll over, right? How many times have we seen this before it does this? Right? Does it up here? Does it here? So you see it quite often. These good rallies on the lower time frame look amazing. Everyone gets excited, and then before you know it, they're wrecked again. Yeah. So pay attention to the traders that get excited on the small moves when there's obviously much more at play.
Yeah, and the moves into resistance, right? That's always the best part, right? Is we see, like I was saying in the stream, right? We dropped 20% over the last 2 weeks, and then every time we've rallied 3 to 5%, everyone's like, the bottom is in, right? How many times have we heard the bottom is in over the last 2 weeks? It's when people stop saying the bottom is in and they think we're going much lower that usually the bottom is in. So that's kind of the sentiment analysis that then you can also get to kind of build into your trading is one thing I use Twitter for, right? Is okay, I'm following certain people, I'm seeing what the sentiment of the market is, and there's going to be accounts that you can follow that you will see, every kind of top, they're euphoric, every kind of bottom, they're extremely bearish, and it's almost like clockwork.
Yep.
Um,
You can counter
but yeah,
trade them. I've got a list
yeah,
of counter traders when
so do I.
yeah.
So do I. I think
Yeah.
I think everyone has a list. You keep it private
Yeah.
of who you kind of look for, who are kind of highly emotional at tops and bottoms, and
Yep.
that's what makes the market, right?
Yep.
That's what that Wall Street cheat sheet is. It's not a chart. It's a chart of human psychology. As the market cycles over and over and over again. So I don't want to keep you here too long, man. We're already coming up to like an hour and 40 on this stream. Is there anything else you specifically wanted to cover here?
Probably just simple things like this. So for me, that was an order block. This is a chart I posted about a year ago, saying if you're not in the market, you need to get all in there pretty much now. And that was simply just off a weekly candle, naked price action really, of a key level through here. And it was, well, I think we're repeating that at the moment on where we currently are. We're doing the same behavior right here on Bitcoin over an entire year though. So if we go and zoom out of Bitcoin, everyone's getting freaked out about the highs and the lows. But really, if this wasn't the top, then this is definitely not the top based on my experience of macro. So this entire thing has just been reaccumulation, which means this bull run could go for another 6 to 12 months, in my opinion. Um, we could just carry on. The super cycle could be very real that they meme about. Uh, Never in
The the
Bitcoin's history
the
has it done
problem
this.
the problem is though is people get lost in the low time frame, right? Like you
Yep.
said, they're getting lost on these low time frame pullbacks, forgetting the macro picture. And I had someone in the stream to say today, why are you looking for shorts in a bull market? It's like I'm looking at the 1 hour chart here, and I'm looking
Yeah.
at a potential short down to, a couple, percentage points lower. On the macro, you cannot tell me that this looks like we're putting in a massive higher low after coming out of that 40K range. Like that looks like it doesn't take a rocket scientist even on the daily here. This looks like an uptrend is forming. I'm looking for reasons to get long on the macro. I was just sharing some short-term potential price movements because a lot of people are day traders and they say, I don't care where we're going to be in a month. I want to know where we're going to be this week, right?
Exactly.
The real money is made. I know he showed the spreadsheet guys where being like, listen, over 1,000 trades. The real money is made understanding the macro direction of price and then positioning yourself accordingly. Unfortunately, no matter how many videos you watch, most people will never make it actively trading. It's a very hard thing to do. I don't think most people are profitable over a long period of time actively trading, but you can make lifetime gains, retirement money for you and your family by being on the right side of the macro move and just positioning yourself in spot, right? Most
Yep.
of the
Yep.
money that most of you are going to make are going to be getting into spot after huge dumps and then just waiting. I know it's not as sexy or as fun as, catching the bottom tick on a trade, but the chances are if you bottom tick this SFP, you're already taking some profits. You're not holding that to 100K Bitcoin. But what you are doing is saying, okay, when we drop from 60 to 40 in a matter of a few days, I'm going to buy spot here and I'm going to 3x my money over the next couple of months, right? That's where the real fucking money is made for most people.
I agree. I completely agree. All you need to be is exposed to the market for the upside moves. The majority of the money doesn't come from trading; it comes from holding in crypto anyway. You just build your capital 1% at a time. You risk 1% at a time to increase that, but ultimately it's the holding, buying maybe the higher low that comes in here, and just riding this from that point onwards. You don't have to catch this. You don't have to catch all of this. You can improve your skills tenfold to be able to catch this kind of stuff, like myself or probably you. Um, but you really don't need to. The money's made in the middle. You just need to make sure that you're buying healthy uptrends and selling obvious downtrends, and not trying to hold in between. Unless your strategy is holding, then just ride out
And,
whatever it is. Make sure you've
and,
defined your strategy first, though.
and making sure that you have money to buy those dips and you're not losing it all in, what looks like a major downtrend on the hourly, which in reality on the daily and the weekly is just a pullback before a higher low. You don't want, I always liken this to, gambling or, playing poker or whatever, right? You don't want to lose all your chips before you finally get that, pocket aces, right? Because you've been going in on kind of shitty hands. You don't want to lose your money, um, in the in between parts. You want to have that dry powder for when those, really big opportunities come to get yourself exposed to the market. And I completely agree. I don't think this bull run is over. I'm looking for that macro higher low. That's what I'm aiming for right now, and making sure that I'm positioned to take advantage of that. And that means, where am I looking for it to form? That's part of it. Having money to get exposed to the market, and then also having a plan for when we get to those areas, right?
Yep, completely agree. I think for this market to go bearish, we'll have to reject at this particular level here. Because when I look at this as a range, I think you do the same thing. You break this whole thing down into one big range here. If this is going to be distribution, or if this is the top, usually we'll come back and bearishly retest this level, this range, and then just roll over. And that's when you'll get that extreme volatile down. We'll break the uptrend. A bit of a meme, I'll use a trend line here. But if we get that higher low come in, after making a higher low, so the lower high through here, we get one more lower high, especially after this SFP nasty top through here, and we look at the monthly candle, for instance. That monthly close in a couple of days looking pretty ugly right now, but it can still be saved. But having this overshadow the previous wick here, this wick here, and then still closing below that, what I'd call as a supply candle through here, we close below that on the monthly, I'm going to be a little bit concerned. If we close in or above it, then I'll be continually be bullish, because it's just a doji in an uptrend, right? If you zoom out, it's not that bad. Then we've got the weekly and the rest of it. I think with the
Well,
weekly that's just come in, hey?
this is why you have to have multiple things you're looking at, right? Candlestick patterns can be good, but it's not enough to just be like, oh, it's a spinning top or it's a doji, the top is in,
Yep,
right?
yep,
Everything requires context.
exactly right. So what I'm looking at the moment on the weekly, the macro, just for the structure we're currently in, this is currently a range we're in, a daily range. But we can see that we've swung the high and then we sold off. We've swung the low, we've closed back above, and now we're probably going to hit back up. A really good example of this is actually, I think it's on the monthly here. So we've just done that exact same thing on the monthly, where we swung the high, we sold off, and then we swung the low, and then closed back above. So I think we're going to see the same thing, where we might have a bit of a fuck around week this week here, and then head back up. I could see a macro high up into supply, or an order block here. Usually I'd call that one an order block, and then reject here, and then come down for one more low. Bull markets love to do this particular structure. You'll see it everywhere once you notice it. I'll draw it and identify it. So usually the market does this. You come up, you make a nice high, you come back down, and you come back up, you make a lower high. It's usually some kind of low time frame order block through here that you reject that. You make that one more low, then you come back up, and you breach trend usually. That's usually how it looks, like a bit of a bull flag looking thing. We can see that exact same thing right here, where you come up, you swing low, you come back up, you reject the previous range through here, you come down, you accumulate, usually have one more higher low here on the trend retest if you're a trend line trader or you observe them, and then you push up. So that's what I look
Well,
for.
and you're also reclaiming that key swing low, right? That
Yes,
swing low
exactly.
that got broken through at the end. That's your horizontal that you've, kind of reclaimed. Exactly, right there. It's like, okay, we made that third drive, deviate below, we're back above. That's generally bullish. And it's an awesome way to get people bearish, right? If you're the one painting the chart,
Yes,
you go,
yep,
I'm going to break this swing low. Everyone's going to say, okay, we just made a lower high, lower low. And to me, initially, yeah, I think it is bearish. But when we reclaim that low quickly, to me, that's actually a sign that they just trapped a bunch of people short. Let's send it the other way.
yep. You gotta work out where's the path of least resistance. SBF and Sam Tabasco Source always talk about that. The path of least resistance. You need to understand price action. Where is the most pain, and the market will probably head in that direction. I think we are potentially doing something like this at the moment, and we can still see that one more low. So we come back up here. We have those three drives down. All right, we got the SFP here, but there's still a chance that we just maybe break that trend line temporarily. Um, bull trap a bunch of bulls here before we go for the actual low, and then recover and carry on up like nothing happened. That's pretty much what I'll be watching for. Just rejection of this range low through here, which you can actually really see. So I'd call this a bit of like a supply zone or a demand zone through here. If you're above it, it'd be demand. If you're below it, it'd be supply. So right now we're being sold into here. Um, until we get above that, I'm just going to have a neutral stance and assume more down, because the low time frame trend, low, lower high, lower low, right, lower low again, lower high. The trend is down. You shouldn't buy trend. So if you're shorting, you're gonna more likely than not make money if you were to short like in this area. I think you covered that at the
Yeah.
start of your stream, to be honest. Yeah.
It's funny because, we've obviously come from trading from very different backgrounds, but we've come to the same result here, guys. We're into resistance. We get above there. I'm bullish for higher. For now, the trend is down. If we reject in this area of interest, I'm expecting potentially another low. Macro, I'm still bullish, looking for an eventual higher low to continue that super high time frame trend. But this is just intraday stuff, and it's very cool to see that even though we're kind of analyzing the markets differently, we come up with the same conclusions in terms of what are we looking for, and the levels of interest seem to be pretty much bang on the same. And yeah, no, it's cool to see. I love the way you break down the markets, man.
Awesome, man. Appreciate it. Well, thanks for having me on, Ned. I've been a fan of yours for a while, so as you know, I've been palming everyone and anyone I can to you because you're logical. You've got a very defined approach. It's easy to follow, very educational, so you're helping a lot of other
So
people out as well.
yeah, I appreciate having you on, and I'm gonna have to dig into your content a little bit more myself. Anyone who's interested, I know there's a lot of comments on in the chat, guys. I've left his Twitter in the description of the YouTube video, so go check it out there. I believe he has a website. There it is, right there. He's got a website. He's also got a YouTube channel. So check it out if you're interested in this type of trading. I think this is a great resource. I'd highly recommend it. I mean, we've only been talking for about 45 minutes here, and I think this is more alpha than you're going to get going through, hundreds of hours of normie Twitter and YouTube. So there's a ton of hidden gems like Roman out there on Twitter who are sharing tons of free alpha where you can learn from. So I would highly suggest you guys check this out. I've left it in the description. And maybe we'll have you on again when Bitcoin is trading above 100K, and we can gloat and say you called it.
Let's do it. Let's do it. All right,
All
man.
right,
Thank
man.
you.
Appreciate it. We'll talk soon.
See you, mate.